This fast-moving and unpredictable world of cryptocurrency, fortunes can be made overnight, and reputations can vanish just as quickly. Among all the stories to emerge from this new financial frontier, few have been as shocking or as instructive as the rise and collapse of FTX. At the center of it all was Sam Bankman-Fried, known to the crypto world simply as SBF. With his casual t-shirts, messy hair, and disarming smile, he didn't look like a traditional financial mogul. He was hailed as the golden boy of crypto, a visionary who promised to transform digital finance, make trading safer, and even use much of his fortune to make the world better. In just 3 years, FTX grew from a startup idea into one of the largest cryptocurrency exchanges in the world. Valued at over $32 billion, big-name investors poured in money. SBF became a regular on magazine covers and a fixture at global economic summits. And then, in November 2022, everything collapsed. In just a matter of days, FTX went from a billion-dollar powerhouse to a bankrupt shell, leaving an $8 billion hole where customer funds should have been. For many, it was the biggest financial shock since the Enron scandals in 2001. Early life, a brilliant mind with big ambitions. Sam Bankman-Fried was born in 1992 to two respected law professors at Stanford University. Growing up in an academic environment, he was encouraged to think critically, ask big questions, and aim high. He excelled in mathematics, eventually earning a degree in physics from MIT. After graduating, SBF joined Jane Street Capital, a well-known trading firm. There, he honed his skills in arbitrage, profiting from small price differences between markets. He learned how to spot inefficiencies quickly and execute trades in milliseconds. But it wasn't long before he decided to branch out on his own. In 2017, SBF founded Alameda Research, a quantitative trading firm focused on cryptocurrency markets. Alameda's strategy was straightforward: use speed, technology, and careful analysis to profit from price differences across global exchanges. It was highly profitable, and it gave SBF the foundation for his next big idea, the Birth of FTX. In 2019, SBF teamed up with Gary Wang, a former Google engineer, to create FTX. The goal was ambitious: build a cryptocurrency exchange that was more advanced, more efficient, and more user-friendly than the competition. Unlike some early crypto platforms, FTX aimed to cater to both professional traders and casual investors. FTX quickly stood out. It offered a wide range of trading products, including derivatives, tokenized stocks, and innovative features that other exchanges didn't have. Presented FTX as a trustworthy, safe place to trade, a sharp contrast to the Wild West reputation of much of the crypto industry. But SBF also did something unusual for a finance CEO. He embraced the philosophy of effective altruism. He said he wanted to make as much money as possible so he could give most of it away to causes like pandemic prevention and fighting climate change. This mix of financial skill and apparent selflessness won him fans far beyond the crypto world. Rapid growth and celebrity endorsements. FTX's rise was nothing short of meteoric. In just 2 years, it had grown into the third largest cryptocurrency exchange in the world by trading volume, attracting heavyweight investors such as Sequoia Capital, SoftBank, and other major venture capital firms. Sam Bankman-Fried, known as SBF, knew how to craft a powerful public image. Under his leadership, FTX bought the naming rights to the Miami Heat's NBA arena, partnered with Major League Baseball, and even ran star-studded ads during the Super Bowl. Celebrity endorsements from the likes of Tom Brady, Gisele Bündchen, and Stephen Curry helped cement the brand's credibility in the eyes of millions. The strategy paid off. Customers from all over the world flocked to FTX, and by early 2022, the company was valued at an astonishing $32 billion. SBF's wealth soared past $20 billion, placing him among the richest individuals on the planet. His influence grew as he appeared at global conferences alongside political leaders and donated millions to political campaigns, further boosting his public profile. Cracks beneath the surface. Beneath FTX's polished public image, serious problems were quietly building. With deep connections to Alameda Research, Sam Bankman-Fried's first venture. Alameda wasn't just a separate trading firm, it was one of FTX's largest clients, creating a risky overlap. Internal controls were alarmingly Reports later revealed that the company lacked proper accounting systems, and a small circle of executives made major decisions with little to no oversight. Even more troubling was Alameda's heavy reliance on FTT, the cryptocurrency token created and largely controlled by FTX. Alameda's financial stability depended on the value of a token that could be influenced by its sister company, raising major conflict of interest concerns. After the collapse, John J. Ray II, the veteran brought in to manage the bankruptcy, summed it up starkly. "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. It was a disaster hiding in plain sight." The beginning of the end. The first real sign that something was wrong with FTX came in early November 2022, when crypto news outlet CoinDesk published a leaked balance sheet from Alameda Research. The document revealed that a large share of Alameda's assets was tied up in FTT, a token created by FTX itself. This was alarming because if Alameda ever had to sell those tokens in large quantities, their value would drop sharply, taking Alameda's balance sheet down with it. The revelations shook confidence in both FTX and Alameda. Binance, the world's largest crypto exchange and an early backer of FTX, publicly announced it would sell its holdings of FTT. That announcement triggered a market panic. The price of FTT nosedived, and FTX customers, fearing the worst, rushed to withdraw their funds. Within just 72 hours, FTX was swamped with billions of dollars in withdrawal requests. But the company didn't have the cash to meet them because much of the customer money had already been used elsewhere. From empire to infamy, the collapse, arrest, and conviction. By November 11, 2022, the empire Sam Bankman-Fried had built came crashing down. FTX, Alameda Research, and more than 100 related companies filed for Chapter 11 bankruptcy in Delaware, revealing a financial black hole. Bankman-Fried resigned as CEO, and court documents later exposed an $8 billion shortfall in customer funds. The truth was damning. FTX had been using customer deposits to cover Alameda's massive trading losses, a move that directly violated its terms of service. In simple terms, customer money was secretly gambled away without their knowledge or consent. The legal fallout was immediate. Authorities in the Bahamas, where FTX was based, froze its assets, while U.S. regulators such as the SEC and the Commodity Futures Trading Commission launched investigations. On December 12, 2022, Bankman-Fried was arrested in the Bahamas at the request of the U.S. government and quickly extradited to face charges of wire fraud, securities fraud, and money laundering. During his trial, prosecutors painted a picture of one of the largest financial frauds in history. Key insiders, including Alameda CEO Caroline Ellison and FTX co-founder Gary Wang, testified that Bankman-Fried had instructed them to deceive investors and secretly funnel customer funds to Alameda. In November 2023, the verdict came: guilty on all counts. The following March, he was sentenced to 25 years in prison and ordered to forfeit more than $11 billion. The story of FTX's rise and fall became a cautionary tale, not just about crypto, but about unchecked power, misplaced trust, and the devastating cost of financial deception. The human cost and echoes of Enron. The collapse of FTX was more than just a financial debacle. It was a human tragedy with far-reaching consequences. Millions of customers suddenly lost access to their funds, with some seeing years of careful saving vanish overnight, while others lost money they could ill afford to risk, lured in by the company's carefully cultivated image of safety and credibility. The emotional toll was immense, as individuals and families faced the reality that the trust they had placed in the golden boy of crypto had been misplaced. Beyond the personal losses, the shockwaves rippled through the entire cryptocurrency market. Prices for major assets like Bitcoin, Ethereum, and countless other tokens fell sharply, wiping billions from the industry's total value. Confidence in centralized crypto exchanges, once the backbone of the industry, evaporated almost overnight, leaving investors wary and hesitant. The fallout drew inevitable comparisons to the Enron scandal of 2001. Like Enron, FTX had relied on complex and opaque financial structures to mask underlying problems, while being led by a charismatic figure who promised groundbreaking innovation and change. Both companies collapsed suddenly, wiping out enormous amounts of wealth and shattering public trust. The lesson from both disasters is as relevant now as ever. In the world of finance, whether traditional or digital, transparency and accountability are not optional. They are the bedrock upon which trust is built. Without these safeguards, even the most celebrated and seemingly untouchable enterprises can collapse in an instant, leaving behind a trail of financial devastation and a sobering reminder of the cost of misplaced faith. Lessons for the future. The collapse of FTX has made people realize just how badly the crypto world needs stronger rules to protect everyday investors. One big idea being pushed is something called proof of reserves, which would mean exchanges have to show regular, independent audits proving they actually have enough money to cover all the deposits from their customers. This would help build trust and reassure people that their funds are safe. There's also a need for much better internal controls, so companies have proper systems in place to stop money from being misused. Another important step is keeping trading firms and exchanges separate, so one isn't using the other's money or making risky bets that could harm customers. And because crypto is a global business, regulators from different countries will need to work together. Without that cooperation, bad actors can just move their operations to wherever the rules are weak. Conclusion: the story of FTX is a reminder that brilliance, charisma, and good intentions are not enough to guarantee ethical behavior or sound business practices. Sam Bankman-Fried rose faster than almost anyone in the history of finance and fell just as quickly. In the end, FTX's collapse wasn't caused by a flaw in cryptocurrency itself, but by human decisions, control without accountability, and ambition unchecked by ethics. As the crypto industry rebuilds, the memory of FTX should serve as both a cautionary tale and a guide. The future of finance, whether digital or traditional, depends not just on innovation, but on trust, honesty, and the willingness to put customers first.